Hello and welcome back. Let's take a look at Twilio, a company that has been hurt along the other ones as well. It has lost about 78% of its value, as you can see here in the last year, and you will see it in the chart. The company used to be for a while actually sitting at around 120, 30, 40, and then all of a sudden it went up, like super up to 444 almost at some point. Actually, even more, 400, more than 450, and then went down massively. And right now it's sitting at $226, up $24 today, actually, 12% higher. And you will see that in the last 5 days, it actually used to be about 200, and now it's or actually even more, 190 over here. So after the latest earnings report, it looks like the company stock price is soaring a little bit, yet still very far from its all-time highs, of course. It's like 50% down still. But let's take a closer look, see if this kind of discount is actually worthwhile for us, and if we want to examine it for potentially adding this to our portfolio. The outstanding shares of the company seem to be low, but let's take a little bit of a closer look at how they have been increasing over here. You will see that back in 2016 over here, the company had 83 million in terms of the outstanding shares, and now they're having 178 million, which is like an almost 3 times increase, right? A little bit less than that, 2.5 or something, which is massive. I mean, this is horrible for investors. They have been diluted massively, and if you are a stock owner, you feel that because there are more stocks traded as the company keeps increasing its outstanding shares count. Thus, they are diluting you, and so your shares are actually worth less now. And in some situations, if the company makes a lot of money, they can potentially compensate for that. But let's take a look at what Twilio does over here. So, it doesn't have a PE, which is interesting. It means that the company is not making money at all over here. And price to book ratio of 3.7 is not that high. I'm not too worried about this. But let's take a look now at the income statement of the company here. And I'm going to take it from 2017 to 2022, which is what I like to do. The nice thing about the company, you will see here massive year-over-year growth, which doesn't seem to be stalling as well. Like it's about 65% in the last 12 months from the previous 12 months. So that's pretty good over here. And the same thing with the gross profit growth. Company keeps increasing its margins here. So what about the net income of the company? The net income of the company, which is a big problem, used to be negative, but minus 63 million here. And now, as the company is actually increasing its margins over here, as you can see, still the company is losing more and more money, and it doesn't seem to be decelerating. Really, it seems to be accelerating. So currently the company is losing about $1 billion a year over here, and they are very far from profitability, it looks like. They have provided some interesting guidance for the next quarter, but we'll see what happens really. Now, in terms of the total assets of the company, they are growing, but of course we need to see why they're growing. If the company is not making money, where do they find the assets from? We'll see. And we'll take a closer look at that at the cash flow statement. But first, let's examine the total equity of the company from $300 million to $11 billion right now. And again, you have to be asking yourself, how are they making all this money? And you will see here the additional paid-in capital. Look at that, 4 billion, 9.6 billion, 12.9 billion. You know where that comes from? From the stock dilution that we saw earlier. The company was issuing massive amounts of shares, basically funding operations through that, and that's how they have that much equity here. It's the stockholders that are paying for it, not the operations of the company. Cash flow. The cash from operations is basically zero here. If you average it in the last 5 years, it's about zero. As you can see, the company is not really making money, not losing much, but making almost nothing really. Cash from investing, the company is still investing, I guess, with the stockholders' money. And what about the cash from financing? As you would expect, even more issuance of common stock over here, and some total debt issued here as well. So debt, issuance of common stock is how the company is funding themselves. And as expected, the free cash flow is in the negative because the cash from operations over here was very close to being zero. And then if you extract the capital expenditures from that, you get the free cash flow. And then the free cash flow becomes negative. 12 minus 12, almost close to zero, like 3 million, 7 million here, and then losing 45. So it's a company that's basically kind of balanced out. It's not making much, at least it's not very negative. That's at least the good thing about it. And the multiples of the company, as you can see right now, they keep increasing here, pointing to a company that is getting more and more overpriced here. You, generally speaking, want lower multiples when you're investing in a company, because it means you're getting more sales for the enterprise value. And the enterprise value is about the shares multiplied by the stock price. And so you want this to be low when you are purchasing the company. It's not the case here. And what about the profitability? You'll see obviously the return on equity is negative here, another bad sign. The company is not making money right now. The total debt to equity is low, and that's because the company is getting debt, but it has actually a lot more equity, which again comes from stockholders. It comes from people who are buying the stock, because again they keep issuing more and more, and that's a thing that a lot of people don't really recognize, but it's a killer for an investor. And you're just taking a quick look at this one. Like the moment I see this, the amount of extra outstanding shares, this is an instant no for me in terms of investing. The company is using investors to fund their operations and massively using them. It's not like a 10% increase here. This is like 3 times almost, and it doesn't look to be slowing down. So that's something that I definitely don't want to participate in. And you can take a look here at the cash flow again, and you will see that it's in the negative, and so you don't have much to use here in terms of its free cash flow of the company. It's like zero to calculate how much you would potentially want to pay for this one. And the company has a $40 billion market cap, which would normally be indicative of a company that's making about $2 billion in terms of free cash flow a year or so. This is very, very far from the company. Unless you really believe in the growth story and somehow you think that Twilio will have massive margins later and actually manage to keep a lot of the money. But again, how much are you paying for that today is the question. And for me, I'm not really willing to enter the current this company at the current stock price, because I think it's very, very overvalued, and I'd like to get a much, much, much lower valuation here for Twilio in order to even think about potentially getting into a company that's basically not making money right now, and also losing more and more money, regardless of the growth in terms of revenue. That's also another thing that's very, very bad to see. I don't like to see that. So hopefully that gives you an idea about Twilio. Let me know what you think in the comments below. And if you do like these kinds of videos, please like the video and subscribe. I'd love to see you around. And you may want to join our Discord channel as well. You can find the link in the description box below. And again, thank you for watching this one. If you did enjoy it, take a look at this video that I made earlier about Alibaba, and I'm giving away a free DCF model, discounted cash flow model, for all of you who want to have a very, very easy tool to examine companies and be able to create a very quick model to see how much you should be paying for a company in order to make a specific amount of money back from your investment. Thanks again, and I'll see you soon. Bye-bye.